Welcome back, everybody, to another great episode of SF Live. This will be a great one because I have my friend Matt Geiger back with me here in the virtual studio. And Matt is one of my favorite guests on the program, I have to admit. He's roughly my age, actually younger than me. Super insightful. He does a lot of site visits. He's got his finger on the pulse even more than we do here at SF Live, chatting with everybody. So really happy to have him on the program. And we're going to talk about what the markets are like. Like as you know from our conversations, I haven't even been the most positive, and he has to manage a fund. So I can only imagine what his mood is like. But I've read his recent investor letter. A lot of positive things in there as well. He drew some conclusions and comparisons to previous bear markets and what it might mean for us here in the future going forward. Really looking forward to that. He's been on a lot of site visits just in recent weeks. Looking for a common denominator and what his impressions were there as well. And always great conversation. So I can't wait to switch over to him. But before I do, let me torture you a little bit and remind you to follow us on YouTube, follow us on Twitter. Hit that like and subscribe button. Helps us tremendously with the algorithm, especially if you enjoy these conversations. Other like-minded investors will get to see the videos as well, and maybe get to make more educated and informed decisions while investing. This is just informational advice, or not. This is not financial advice. This is educational content at its best, and you hear it straight from the horse's mouth, and we're really excited to do that. I said my piece. Matt, welcome on the program. It's great to see you again.
It's good to be back, Kai. And man, the world has changed since our last conversation. This would have been earlier in the spring.
Yeah,
a lot of
I
lot
just
of pain.
rewatched our interview a little bit, and the body language was very positive out
Yeah,
there. So
world of difference. I mean, I would argue it could be a lot bleaker. We have had a little bit of a recovery rally here over the past 4 to 6 weeks. So I think folks may be getting a little bit complacent and forgetting the pain that we felt just as recently as June and early July.
yeah, quite positive note. I don't think it's subsided. I thought we've seen a bit of a rally in gold while we ran back up to $1,800, and then the junior stocks completely dropped off again off the radar. And part of it is seasonality. How do you see that? How does seasonality factor in right now?
That's a big factor. I mean, we'll have to see what the broader markets do. I mean, that's kind of what I'm honing in on in terms of the near term direction of the junior markets. I think there's a chance. I mean, I don't think it's controversial to say that we've been in a bear market rally here since mid June. At least for the broader markets, took a 2 or 3 weeks lag for juniors to see a little bit of buying activity. Um, I think it's possible that that this rally goes on for a couple more months. I wrote about in the most recent MJG investor letter that two of the four major sell-offs of the past century here, honing in on the great financial crisis of 2008, 2009, and then the Nifty 50 bust of 1973 and 1974. In both those cases, the first leg of the bear market saw the index fall well below its 50-week moving average, so very long-term moving average. And then both of those saw bear market rallies that went up and basically kissed that 50-week long-term moving average before multiple legs lower. So were that to repeat, no guarantees that that's going to that history will repeat in this case. But we could see the S&P run up to 4375 is the level, give or take. So I don't think that's out of the question at all. If that's the case, I think we could see some buying activities in juniors for the coming month or two. We're obviously going to see news flow pick up quite a bit because you'll see a lot of these companies hold off on releasing news releases up until Beaver Creek. So that's occurring September 13th through 16th. So we're a couple weeks away, and I think it's a guarantee that we're going to see news flow pick up markedly between now and the end of the conference.
Yeah, it's also only a week after Labor Day as well, so I'm sure there'll be a lot of news squeezed into that 4-day trading week.
That's right.
I can even see some Friday afternoon releases just to have something to talk about at the Precious Metals Conference out there in Beaver Creek. Just, in my opinion, is the most important junior mining conference out there at the moment. Interesting. Maybe we could discuss the broader market for a second, because it feels like
Sure.
the Fed and the U.S. dollar has us as junior mining investors in such a tight grip that we cannot escape it. We just heard from Powell from Jackson Hole as well. Moving forward, the next Fed or FOMC meeting is at the end of September with a potential rate increase of another 75 basis points. what do you think will need to happen for that trend change? Like you expect another bull market, like or a bull market, a bear market rally, sorry, in the broader markets for the next 2 months. So you must see something on the horizon that might cause a pivot in momentum.
Yeah, I'm not quite sure what that pivot is, but I mean, just taking the step further back, I do believe in my base case is that we are in store for a pretty ugly bear market here, and I'm just talking generally for the broader markets. There's a few thoughts behind that. The first is just the combination of very high valuations that we saw in the post-COVID era, late 2020, and then well into 2021, as well as just the animal spirits that we saw out there between the SPAC mania, the meme stocks, cryptocurrencies going wild. You can name it. If it was speculative and it was wild, it was happening. So usually when you have those big binges, there's a hangover that occurs. I think the issue here is that in past hangovers, we've had the Fed willing to step in to the rescue. And I think there'll be some sort of pivot here after the next couple rate hikes, but it's not going to be as extreme as folks are probably hoping. The big difference here is inflation. This is the first time in 40 years that it's actually been a major issue on the Fed's radar, and I think they're going to be much more cautious in terms of reducing rates. Should push comes to shove and things get ugly in the general market. So, my assumption is it's going to be ugly for the next 12 to 18 months. As Stanley Druckenmiller said in a recent interview, there's a lot of wood to chop. I think that's a good way to put it after the excesses that we saw in late 2020 and in 2021. Now, the paradox, of course, for us mining investors here, natural resource investors, is that from a medium to long-term perspective, the setup couldn't be any more attractive. Really, across a whole host of metrics, whether you look at commodity prices, physical commodities relative to the general stock market, whether you look at natural resource equities, encompassing oil, gas, energy, mining, relative to the general stock market, whether you hone in on mining stocks in particular, relative to the general stock market, like it looks very attractive over 30, 50, 100-year time horizons here. And so I feel very strongly that there's going to be a reversion to the mean over this coming decade. And usually when that occurs, there's an overshoot as well. So again, I don't know if that's going to, really hit overdrive in 2025 or 2027, 2031, but I do sense that we're headed in that direction. So I do feel the next 12 to 18 months here, and I could be wrong. Maybe I'm being overly conservative. That wouldn't be a bad problem to have. But I think for us in this industry, especially playing amongst the juniors, it's going to be a game of survival here for the next 12 to 18 months. This is not the period where you're going to get rich, but this is where you're positioning. You got to make sure not to be shaken out. And I'm very confident that there is light at the end of the tunnel. But if there's panic in the broader market, if the broader market's going into risk off territory, like it hits our space hard. These are risky equities at the end of the day, regardless of the macro or supply and demand fundamentals for physical commodities. If there's panic out there, then we're not spared, and that's always going to be the case.
We're definitely one of the riskiest industries to invest in on the exchange in general. Just right along with biotech as well. I like throwing those two industries in the same bucket because it's sort of same mantra, same like MO sort of for mining and biotech. You got to go through the phases, the studies to get to a certain production level or to a certain production, right?
I think you're spot on. Yeah, especially the other thing I throw in is just the binary events between those two industries. Whether it's a major permit or a major drill program on the mining side of things, or whether it's a clinical study or one of the multiple clinical studies you'd want to do on the bio side of things. Unfortunately, though, there hasn't been much overlap, at least from what I've seen in Silicon Valley, from biotech investors into junior mining investors. But maybe later in the cycle we'll see that, and that could actually be a contrarian signal to maybe hit the exits
I
once
think you're hanging
mining
out at the
stocks
wrong
become
Starbucks, Matt.
become popular amongst the Silicon Valley folk.
You,
So
you need to
I
go
can
to
be your
another
barometer on
Starbucks.
that. That's right.
No, good point. Good point. It's interesting to see. Like, and once that happens, like the overshooting part is really interesting. I hinted to you like earlier before recording that I've never seen it before, but mining stocks or some of the mining stocks are yielding over 5% right now, and that already is a sign. Like, I'm even thinking about shifting some of my capital from the juniors into the big caps because a 5.5% dividend yield is nothing to laugh at in mining.
That's right. I mean, it's notable. Yeah, whether you're looking at the gold miners, or really across the board. I mean, Kazatomprom right now is at a 6 or 7% yield. If you want some uranium exposure and are looking for a yield, obviously you have to be willing to stomach some jurisdictional risk there, to say the least. But yeah, I mean, my sense is that dividends are going to come to the fore here over this next decade. Like my general theme, and there's kind of three overarching theses I have. The first is really from the end of the Great Financial Crisis to, we'll say, COVID. The U.S. has run circles around the world, the global economy. I think we'll see the pendulum swing back towards emerging markets over the course of this decade. Likewise, we've seen growth absolutely triumph over value over the past 13, 14 years. I think the pendulum's going to shift back. So that's where the dividend aspect comes in. And then the third is that passive investing has run supreme here over the past 13, 14 years. I think we'll see pendulum swing back towards active investing. But yeah, to your point about the dividends, perhaps, and I think there's a chance that could actually introduce some generalist interest into our space. That could be one catalyst to get generalists to start coming back into natural resources. And then if they start doing well with those investments, we may see the trickle down effect that we've seen in past bull markets.
It 5.5% is something, again, I've never seen it. It's nothing to laugh at because you also get sort of the leverage to gold as well. So it's a double whammy in my opinion, right?
That's right.
Like, are we in a recession, Matt? I think it's a question everybody needs to ask and answer for themselves because the definitions change apparently quite widely. And the follow up question to that, Matt, is how is your portfolio positioned? Like, are you taking that into account? Have you shifted your portfolio around a little bit since our last conversation there at the end of March?
Yeah. Well, in terms of the recession piece, that's a little bit beyond my pay grade. I mean, in the States, we have had two negative quarters of economic growth in a row. That used to be the strict definition of recession. There's now some debate on that. I will say, usually during recessionary periods, you'll see the unemployment rate tick up, and we've yet to see that occur. But there's also a good 6 to 9 month lag typically between rate hikes occurring and then their actual effects being felt. So I think we will start to see the unemployment rate tick up. Once that occurs, I'd be more confident saying that we are in a recessionary period. Now, as it pertains to the MJG fund, we ended Q2, so this would have been June 30th. We ended at around 15% cash weighting. Which is pretty high, at least historically, for how the fund has been positioned. There's been many years where we've been close to fully deployed. I will say that we've put a little bit of this cash to work over the past 6 weeks or so, but only through open market purchases of existing positions within the MJG fund. So we've averaged down on a couple high conviction names here, just because I think, at least in the short term, the selling got a little bit out of hand, especially as we got towards mid-July. That said, I do, especially if things continue to run, and I wrote about this specifically in the letter. I do feel we're in a bear market rally now. Should that continue, the cash position, you could expect that to shift up closer to 20% or so. And then when things get ugly again, we'll just start deploying it on a monthly basis in a drip like fashion. So that's the rough game plan. I'm not trying to call the bottom here, get that right by any stretch, but more during times of panic, just start dripping money with the sense that things will turn maybe late 2023, early 2024. So that's when we would be fully deployed around the spring 2024 timeframe. So, and again, perhaps I'm wrong. Perhaps the broader markets bottomed in June, and we're off to the races from here. If that's the case, we still have 85, 80% of our portfolio deployed. Like, we're going to do great. So that's kind of the message that I tried to harp on to MJG Partners. We're still positioned for a move in this space, but I wanted to be more conservative than we had previously.
I personally hope you're wrong because I'm graying already. So if we have to wait another 12 to 18 months for the markets to turn around, I'll have a full head of gray hair. Like
Yeah.
I'm not sure I'll manage that. But I looked through your portfolio because I read the MGG letter earlier today as well, and I noticed you have 0% exposure to producers. Right. I know you've never been big on producers. I know you have quite a few royalty plays. You like the junior explorers, but maybe explain it to us again. Like, why zero exposure to the producers, and do you see that changing anytime soon?
It may change. I've always had a bias against the producers. I mean, I just think the royalty business model, hands down, is by far the best way, especially over longer periods of time, to invest in natural resources or in mining equities. Part of that's one of my investor mentors, Paul Stevens, has made his career amongst the royalty names, so that's rubbed off on me to some degree. But I just love the combination of low overheads, combined with the diversification that are afforded by royalty vehicles, and then of course the discovery optionality that you get from holding these vehicles over long periods of time, where you basically have multiple producers or developers exploring on your behalf across multiple properties. And in mining, if you're getting exploration upside for free, good things can happen. Good things have happened for a lot of these companies. So, yeah, we're very heavy on the royalty names. I mean, I think our weighting is around 25%, maybe up to 30% of the fund currently. I should say though, these are all junior royalty names. So the largest of the bunch, in fact, our largest holding by market cap is Altius Minerals at an $800 or $900 million Canadian. So I should emphasize that it's on the smaller end of the spectrum, and I should also say I have an acute bias towards the junior royalty names that have the ability to organically generate royalties. So Altius falls into that category. Alta Strategies is a company that I've written about in recent MJG investor letters. They just merged with Elemental Royalties. And then EMX are kind of three examples of names that come to mind where they have that geological expertise within the front office there, that are able to go out and create royalties on their own, as well as go out and purchase royalties opportunistically if the right opportunity comes.
Yeah, no, makes a lot of sense, and I can definitely follow that logic. I've talked with EMX quite a few times. We had them at the Deutsche Goldmesse. I really like their business model, and it's time for them to have another win and hit it out of the park again. So,
Yeah. I mean, one concern just on the royalty front is the proliferation of the names, particularly on the junior front. I mean, look back to 2020 when gold and silver were going wild, and it seemed like there was a new royalty name sprouting up every month or so. So that's concerning for me. When you see a bunch of vehicles pop up in a specific place, that usually means that whether it's a business model or whether it's a commodity like lithium, that tells me that the run is getting long in the tooth, so to speak. If anything, we've seen a swing to the reverse here with the royalty names, which is encouraging from my perspective. I mentioned the Altus Elemental Royalties merger that just wrapped up or just concluded a week ago or so. So that's all done and dusted. We saw Great Bear Royalties taken out by Royal Gold in the past 90 days or so, and then earlier this spring we saw Sandstorm take over Nomad Royalties as well. So it's good to see three of these names off the board. I think it's always better for an industry or a subset of our industry if there's less vehicles out there clamoring for investor attention and also competing in new potential deals. So it's beneficial on both of those fronts.
absolutely, no, it makes a lot of sense. Let's change the momentum a little bit. Let's change maybe the mood of the conversation a little bit as well. You've recently been on quite a few site visits, and some of them were actually EMX has a connection to. That's why I came to the site visit part because to make that segue.
Yep.
Like Mill Rock Resources, I think you've been to as well, and a couple other projects. I think Contango or is an EMX project, or at least associated with that group. How was your trip? You've been to Alaska for quite a while. It was at least a 10-day trip, and I'm always curious when you do 4 or 5 like site visits back to back. There's always seems to be an underlying theme, right? There's always that one word that keeps coming up every time. So I'm really curious what your impressions were and what you took away from the trip.
Yeah, no, it's been a busy couple weeks. I was in Nevada to visit three Ridgeline Minerals properties. So that's an EMX linked junior that we have indirect exposure to via EMX. And then you mentioned Millrock as well. We have indirect exposure to Millrock, both Millrock shares and royalties over some of their land package around Pogo. Via EMX. So it was good on both of those fronts. I don't believe that Contango or has an EMX
I might have
connection, I
mixed that
should
up.
say.
So,
Yeah, no, that's they have a 30% stake in a very high grade project called Mancho. And it looks like they're going to break. Well, Kinross has the majority stake there, and it looks like they're going to break ground later this year and move towards first production there. They'll be shipping that ore into to Kinross's Fort Knox mill in Alaska. That was one interesting takeaway from the Alaska trip. Just how long Kinross in particular. I mean, they're a major player in that state, and it's so hard to build a major processing facility and get that permitted these days that they're just going to let Fort Knox run as long as humanly possible. And so that includes there's bulk tonnage, lower grade deposits nearby. The Fort Knox pit is still going. They have the Gill deposit nearby, but they could also use some high grade shipped in from other parts of the state. So I think that's what Rick Van at Contango Ore is pursuing. They have a couple, I would say, on the smaller side, but very high grade projects, and in some ways, you could say they're functioning as Kinross's exploration arm within Alaska. We were able to visit High Gold and their Johnson Tract project as well. I think those guys are aiming to, in a best case scenario, they're going to find enough material there for a standalone operation. But I think from their perspective as well, in a worst case scenario, that deposit already has the grade where it could also be shipped into Fort Knox in a future scenario. So, no, a lot of busy, a lot of traveling. I mean, in terms of what stood out, I mean, Snowline kept coming up. Like that is the topic du jour these days, and even whether in Alaska or in the Yukon. I mean, I have a few thoughts on that. I think there was a piece put out by Trevor Hall from Mining Stock Daily. I know you're friendly with him. It got a lot of buzz on social media, quite a bit of stirred up quite a bit of controversy. And I will say, I read his piece. I thought it was pretty uncontroversial. I agreed with
that's
all.
what I thought. That's why I was surprised. It was like I was on vacation that week when that came out. I only saw it
That's
like a
right.
few days later. I was like, why are we having this like online fight here? Like, what is happening?
I think what he portrayed was accurate. Firstly, it's a very exciting discovery. I don't think there's any question about that. Yes, it's extremely remote, with lack of infrastructure. Yes, that's a difficult and actually dangerous place to explore. They're located near ATAC, and there was the very unfortunate passing of a promising female geologist, and her pilot, Julia Lane was her name. This was back a couple years ago. But we'll have to remember this is right near the Rogue project, so it's very tough to operate out there. But I'd say the discovery is real, and the people behind it are very deserving. The Birdalls are wonderful people, to my understanding. I don't know them particularly well personally. They've been working in this area for 30 years. Like they're very deserving of a discovery. So I think both of those things can be true, but you can also say that putting a 55% probability on a 50 million ounce discovery with no grade even contemplated is irresponsible. So I think all three of those things can be held true. We're not Snowline shareholders, but I'm following along, and for the sake of the space, I want them to do well. I think it also demonstrates that even in crappy markets, value can be created if there's that special of a discovery. And I should add, I mean, it's a similar story at Western Alaska Minerals and their Illinois Creek deposit. That was another project that we were able to visit in Alaska. A little bit less controversy around that one, but I'd say it's a similarly very deserving team. CEO there, Kit Spring, and his right hand man Joe Pirkenbach, very hardworking, salt of the earth geos that know Alaska inside and out. This is their first foray, as kind of the leading management team of a junior company. So they definitely will, have some things to learn on the capital markets front. But these are honest, well-intentioned, hardworking people, and it's good to see them succeed as well.
Absolutely. As you said, I think it feels good to make some money in the markets. Like have some real discoveries and have some share price appreciation. There's not a lot of stocks that are going up these days in the junior mining world. So, and if you can own one of those winners, congratulations. Right?
That's
That's
right.
That's
That's
fantastic.
right.
Well deserved. Matt, great conversation. It was great having you on. I can't believe the time flew by already. We'll have you back in about 3 months. We should have, like after the next investor letter comes out, because it's always super insightful. Love hearing from you and appreciate you taking the time. Thanks so much.
Thanks, Kai. Always a pleasure.
Yeah, thanks for coming on. And to everybody else, thank you so much for tuning in. This was SF Live. We were joined by the fantastic Matt Geiger over at MJG Capital. Go visit his website, sign up for his newsletter. All the previous issues are on the website. The most recent one from the end of July, I think it was July 21st, it was published. Super insightful. As I mentioned, Matt drew some conclusions and comparisons to the previous financial crises to the current one. So something to learn from that as well. And follow us on YouTube, follow us on Twitter, hit that like and subscribe button. We really appreciate it. And please come back for more. Thank you so much.